Welcome, this is your Option Monster Volatility Sonar Report. From the floor of the CBOE, this is Jamie Tyrrell of Group 1 Trading. Well, it's been a relatively high volume day so far in the pit. A lot of orders, a lot of spread orders. Now the one we've been highlighting is the June, July, August 1720 call stupid. Now I've been saying that the customer has been selling this spread looking for a change in the VIX term structure. The back month futures are way up above 20, and this customer believes that they perhaps should be falling in line more with where the cash is at 16. So the customer's been selling this spread since it was $5.80. That'd be about $1.92 on each of those call spreads. They're sold it down now today to $5.30. It's traded at various levels in between, but now this is the lowest level yet, $5.30, which is about $1.77 on each spread, about 15 cents lower than where we started. Now it's interesting because the customer, in my opinion, is likely playing the term structure and likely looking for a lower VIX. But the people on the other side of the trade, the market makers, are buying this spread, and rather than holding it as a just long VIX position, they're hedging it by selling the June future, the July future, and August futures. Now the net effect of all these market makers having that same position is that volatility needs to go up. VIX option volatility, that is. They're buying the 17 call, which is very little option premium if you look over at the put, and they're selling the 20 call, which is a real option. It's almost an at-the-money option in all of these months. So they're getting short more and more Vega. Fluctuations in the VIX would be bad for their position because they're hedged delta neutral, and they now have a short Vega position. The impact of that on the markets is that back month options need to go up in price. These market makers are looking for something to buy against that. Straddles, strangles, anything with June, July, August, even September option premium to balance off this giant trade that they've been putting on over and over again. So we've seen a lot of buyers. We've seen buyers of the May 17-19 put spread looking to get some premium back. We've seen buyers of the June 30 calls looking to get some premium back. So it'll be interesting to see what happens and how many spreads this customer has to sell. They've sold about 60,000 1720 call spread stupid. So 60,000, that's 300,000 option contracts. This order is presented in a very similar way to the January and February 2022 call spreads that we had a customer come in and sell 150,000 of each, and those spreads eventually finished out of the money as those futures leaked down. So we'll see what happens with this, but it's certainly tracking the customer's way thus far. Started selling 580, still an interested seller 530. We'll see where those futures settle, and we'll see where volatility moves the next few days on that option premium in June, July, and August. Jamie Tyrrell with Group 1 Option Monster.
Hi everyone, this is Noah Warsaw. I'm a designated primary market maker for Group 1 Trading here at CBOE. The reason for my appearance on Option Monster today is I was sent a question by one of you viewers regarding the reverse dividend splits that we saw in ProShares. SRS, UIG, and a number of other names saw 5-for-1 splits, while UIG saw a 10-for-1 reverse split. So what this effectively means is that the share price is going to go up 5 or 10 times respectively, and you're going to have 1/5 or 1/10 of your shares. Now options, of course, are going to be adjusted on all these names. So instead of receiving 100 shares of this new price as a typical American option contract would designate, you instead receive 20. Interestingly enough, though, the reason for these share splits, I believe, is because they want to make the price appear higher so as to sort of negate some of the negative talk surrounding leveraged funds that has become very common in the retail space. A big misnomer about these leveraged funds that they're supposed to replicate the performance of their baseline index over a period of time. So for instance, if you look at UIG, it's the double of XLF. So people would expect that if XLF were to go up 10% in a month, that UIG would commensurately be up 20%. This is absolutely not the case. What the funds are set up to do, and which they do with very consistent results, is they deliver consistent performance on a day-to-day basis from a replication standpoint. So if XLF was up 10% in a day, UIG would be up 20% in a day. However, this does not add up over the long run, so you don't get that long-term replication. Just as a quick example, if XLF was trading $1 and UIG was trading $1, XLF went up 10% one day, you'd expect UIG to be down 20% in one day. So that would put, or up 20% in one day, so that would put them at $1.20 and $1.10 respectively. Let's say that XLF went up another 10% again, it would be up at $1.21, whereas UIG would be up at $1.32. So one would have seen a 32% appreciation while the other saw a 21% appreciation. So you can see how large volatility moves cause these things to break down. The misnomer is often that leveraged funds underperform, when this isn't the case. If you look at UIG starting on November 1st and compare it to where we are now, April 15th, so 5.5 months later, it's actually outperformed XLF on a relative basis, being up 28% while XLF is up only roughly 10. So because of that, these things are very path dependent and depend on a day-for-day movement rather than over the long run. So I'd like to clear that up for any of you who were unclear on that. Hopefully very few of you were. And I want to wish you best of luck trading ProShares and all your other products during this expiration week. Thanks so much for tuning in, and I'll see you guys later. Take care.